Now we're going to begin looking at liabilities and how we account for and we present them for the financial statements. Through the course of this chapter, this lecture, the text, your homework, you're going to see how the financial statement presentation of short-term debt and current maturities of long-term debt is illustrated. You're going to see the difference between interest calculated on a straight line basis and on a discount basis. We're going to discuss what unearned revenues are and how they're presented in the balance sheet. We're going to describe the accounting for an employer's liability for payroll and payroll taxes. We're going to discuss the importance of making estimates for some of the accrued liabilities and show how these items are presented in the balance sheet. We're going to explain what financial leverage is and how it's provided by long-term debt. We're going to describe the different characteristics of a bond, the formal document that represents most long-term debt. We're going to describe why the bond discount or premium arises and how we account for it. We're going to explain why deferred tax liabilities are and why they arise. And we will also talk about what a non-controlling interest is, why it arises, and what it means to the balance sheet. First and foremost, a liability is the obligation of a probable future sacrifice of economic benefits. Definition of a liability. That means that the organization owes this obligation to another entity or person. The term accrued expenses, which you are going to encounter, is often used on the balance sheet to describe liabilities. And current liabilities are those liabilities that are going to be paid within 1 year of the current balance sheet date. Common current liabilities include accounts payable, short-term payable, short-term notes payables, which is short-term debt, the current portion or the current maturity of long-term debt, so the amount of revenue, the amount of principal attached to the long-term debt that will be satisfied in the next year, unearned revenues or deferred credits, and other accrued liabilities. Those that are non-current, for the most part, are the long-term debt in the forms of bonds payable, perhaps notes payable, deferred tax liabilities, mortgages payable, and minority interest in subsidiaries. The recognition being that we have actually recorded it on the books of a liability, means that typically there has been expense recorded at some point already. Expenses always reduce your income. That is the nature of an expense. Remember, it occurs on the income statement. And the lower net income means lower ROI, or a return on investment. Take a second and go back to chapter, I think, 3, where we talked about ROI pretty substantially and some of the different ways that it's calculated. We'll begin talking about current liabilities, because when you're looking at the liability section of the balance sheet, those are the first ones that are represented. We'll move through these different types of current liabilities and talk about those, and then we'll talk about the long-term liabilities. So short-term debt. Short-term debt can be any variety of debt that is due within the next operating cycle, the next year. It can arise from a notes payable, a formal promise to pay, a stated amount at a stated date, and typically there's going to be an interest rate stated. Sometimes it is secured with collateral. That could be, it is secured against a piece of equipment, it is secured against a piece of property, it is secured by the accounts receivable. Just depends upon the nature of what the short-term debt is. Because organizations have typically some type of seasonality to their industry. So, for example, companies that make swimsuits, they need to produce swimsuits with a quasi-level basis throughout the year. That keeps their people moving, that keeps operations going. Also allows them to acquire enough stock to fulfill the rush need for their product as the season is coming into play. However, because they don't have sales occurring in specific times of the year, say the fall and the winter, what they would do is they would take out short-term debt, perhaps in the form of a working capital loan or revolving line of credit, any number of different types of short-term debt, to shore up cash flow so that they can continue operations during that period of time, and then when they hit their season, they pay off that debt. To illustrate short-term debt, we're going to use Matrix Incorporated, who borrowed $25,000 from First National Bank to provide working capital. They had not quite enough liquid funds, so they went to the bank and they borrowed $25,000. The entry to record this, go back to transaction analysis. What increased? What was impacted? Well, we put $25,000 in the bank. So we increased cash. But we now have an obligation to pay that $25,000 at a point in the future. How do we increase cash? We increase cash with a debit. We debit $25,000. Short-term debt is a liability. We need to increase that. That's a credit. So we will credit short-term debt $25,000. The accounting equation stays in balance. Assets increased and liabilities increased. Now, attached to most debt is going to be some type of an interest clause, some type of an interest that is stated. And this is the cost of borrowing. So when you borrow money, people or banks don't give it to us out of the goodness of their heart. They are doing it as their means of generating revenue. How they generate that revenue is by charging interest. So for however long that you are utilizing their money, you will owe them a stated interest rate for that use. This $25,000 note we have bears interest at 9% per year. Interest is almost exclusively going to be quoted to you in an APR or an annual percentage rate. Interest can be payable at different frequencies. The interest for this particular loan is payable to the bank each December 31st. We took the loan in January, on January 1st. We don't have to pay our interest until December 31st. But as each month goes by, each month that we are using the funds of the bank and we are accruing interest, meaning there is interest attached to that specific period, then we need to recognize that in the accounting records. We do that with an adjusting journal entry to recognize the interest expense. That $187.50 of interest is attributable to the month of January because that recognizes the cost of the monies that were borrowed to help generate January revenues. As long as those monies remain outstanding and have not been repaid, they are contributing to the operating revenues of each month. So we debit the interest expense and we will credit a liability called interest payable. When you see the word payable, that means we owe this amount to somebody. It is an obligation that we have. By increasing liabilities and increasing expenses, we continue to maintain to keep the balance sheet or the accounting equation in balance. Now, in prior classes, you should have gone through the basic interest calculation method. The basic interest calculation method, or simple interest, or straight interest, is interest equals principal times rate times time in years. So you take whatever the principal is and multiply it by the APR. That's an annual percentage rate. You multiply that by the time in years, that will give you the total amount of interest for the year. If you take that time in years and instead of multiplying it by 1, take that to a fraction of 12. There are 12 months in a year. If you multiply it by 1 divided by 12, or 1/12, you'll yield the same amount, the $187.50. So it's principal times rate times time. And time can be either an entire year, and then you fraction it down by dividing 12 or 2250 by 12, or you can just multiply it by 1 divided by 12 to begin with, 1/12. That will get you 1 month of interest. If you're given a variety of things, so you know how much was borrowed, how much money, and what the principal is, you know how much interest is, and you know what the time frame is, then you can calculate and back into what the percentage or the APR is. Now, discount. This is a different way that a loan can be provided. So a loan can be provided on what's called discount. The cash proceeds, what your company receives for the note, is provided on the discount basis, which is the principal minus the interest on the front end. So for example, if we had a the same $25,000 loan, 9% interest, then, or approximately 9% interest, what the bank would do is they'd say, you will owe us $25,000, say in 1 year. However, we are going to provide it on a discount basis. You will receive $22,750. The interest calculation to determine the real APR based on a discount basis equals interest paid divided by the money available times time. Slightly changes what you recognize as your interest expense. However, the bank continues to receive the amount of interest that they required. To illustrate how that, my apologies. To illustrate how that is journalized, we're going to continue to use the same loan, except for the loan is discounted. On January 1st, 2016, Matrix borrowed $25,000 from First National Bank to provide their working capital. The note was discounted by the bank and the net proceeds given to Matrix. The journal entry to record this note shows that we had received the net proceeds of $22,750 in cash. So we will debit cash by $22,750. We have a short-term debt obligation or a credit of $25,000. The $2,250, which represents the discount on the short-term note, is posted to a contra liability account. Remember, a contra account has a opposite normal balance from where it sits in the balance sheet. This transaction causes a $22,750 increase in assets and a net or $22,750 increase in liabilities on the horizontal model. Now, this interest that we have prepaid, this $2,250, it represents the full period of the note. The $25,000 note bears interest at 9% APR per year. Interest is payable to the bank each December 31st. With prepaid interest on the note payable, we will reclassify as an expense each month using an adjusting entry. Interest expense is debited $187.50 and interest payable is credited $187.50. The note that will be presented at a carrying value on the December balance sheet. Principal $25,000 less $2,062.50 of the discount for $22,937.50. This transaction increases liabilities and expenses by $187.50 on the horizontal model. Next, we're going to talk about the current maturities on long-term debt. So when we borrow for long-term, we're looking at something that's at inception or parts of it are going to be due beyond the balance sheet date. That's long-term debt. However, in many cases, when you engage in some type of a loan, it begins some of the payments and some of the principal is going to begin being repaid right away. Any portion of that principal that is to be repaid within the year of the balance sheet is reclassified from the non-current liability section to the current liability section underneath the title Current Maturities of Long-Term Debt. Next account that we'll talk about is the general accounts payable. So these are amounts that you owe to suppliers, vendors, individuals like that for goods and or services that have been provided to your organization underneath terms or credit. There are a few things that occur with different vendors. Vendors would like their accounts receivables to turn over quickly, like you would like your accounts receivables to turn over quickly. So they provide a discount. For us, this is called a purchase discount. The terms are the same as you would see if we extended them underneath an accounts receivable side. A purchase discount is the percentage of a discount that can be taken if the payment's received within a stated number of days. Otherwise, the net amount, the total invoice amount, is due by the later number of days. So, for example, if we read this, we read it as 2% discount within 10 days. Otherwise, net within 30 days. So let's look at how that's handled transactionally. There are two methods for recording purchase discounts. We're going to begin with what's called the gross method. Matrix Incorporated purchased $62,000 of merchandise for resale on account. The terms are 2, 10, and 30. If payment for the merchandise is made within 10 days, Matrix can take a 2% discount. 62,000 times 2% equals $1,240. If payment is not made within the 10 days, Matrix must pay the full $62,000 within 30 days. Using the gross method, Matrix will debit inventory for $62,000 and credit accounts payable for $62,000. If payment is made within the discount period, Matrix will then make the adjustment for the discount at that time. Assets and liabilities both increase by $62,000 on the horizontal model. Using the net method, though, we are presuming the presumption that we will take the cash discount. Requires $60,760 to be debited to inventory and the same amount to be credited to accounts payable. Assets and liabilities both increase by $60,760 on the horizontal model. Now, if by chance we did not pay within the 10 days and we had to pay the full amount of the invoice of $62,000, then at that point, underneath the net method, we would make an adjustment when we created the check, and the additional $1,240 that we would pay out over our accounts payable would post to an account called Purchases Discounts Lost. Based on the gross method, when payment is made within the discount period, accounts payable is debited and cash is credited the $60,760. The purchase discounts, a contra expense account, is credited for the $1,240. On the horizontal model, assets decrease by $60,760. Liabilities decrease by $62,000, and a contra expense account will increase by $1,240. Based on the net method, when the payment is made within the discount period, accounts payable is debited for the $60,760 and cash is credited for $60,760. Assets and liabilities are both decreased by $60,760. Now, to illustrate what happens if we do not pay within the discount period, based on the gross method, if we don't pay within the discount period, accounts payable is debited and cash is credited for the $62,000. The horizontal model stays in balance. No additional transactions or entries are required underneath the gross method at this point. Underneath the net method, if we do not pay for the merchandise within the discount period, accounts payable is debited for the $60,760. Purchase discounts lost is debited for $1,240. And cash is credited for the full payment of the $62,000. The horizontal model stays in balance, and the transaction is complete. Now, quite often, we will have what's called unearned revenue. Unearned revenue happens when customers pay for services or products before delivery. This is actually relatively common. Think about things such as paying for a year or 2 years or 3 years subscription for software, paying for your hotel room before you go on vacation, paying for your flight before you take said flight. Unearned revenue is a regular part of doing business. It can also be a deposit for a large job, as well as things like your first and last month's rent. So your last month's rent is unearned revenue for your landlord until the last month of your lease. So on January 1st, 2016, our friends at Matrix received $2,400 in cash as an advance payment for a 1-year subscription to its monthly newsletter. Cash is received in advance for a full 1-year period. Our goal is to recognize revenue as the subscription is provided to the customers each month. So as we fulfill that obligation, we provide that service or that good, that is when we will recognize the revenue. When we received this cash, we had done nothing to earn it yet. So to recognize that, Matrix prepares this journal entry on January 1st, 2016. They debit the cash for the $2,400 that's received, and then they credit a liability account called Unearned Revenue for $2,400. Both assets and liabilities are increasing on the horizontal model. As time goes by through this 1-year subscription, Matrix will earn pieces of this prepaid revenue, this unearned revenue. They will have fulfilled their promise, provided their service or good. So as we get to the end of January and we have provided 1 month's worth of the newsletter, Matrix creates this journal entry to adjust and recognize the revenue that has been earned. We enter a debit, we reduce that obligation to unearned revenue by $200, and then we credit our subscription revenue by $200. The amount of the adjustments are determined by dividing the amount of the unearned revenue that was received in advance by the number of monthly subscriptions paid for in advance. So we received $2,400, we divide that by 12, and that tells us that $200 a month represents 1 month's subscription. Liabilities decrease and revenues increase, keeping the horizontal model in balance. Unless you are a sole proprietorship, you will have to contend with payroll taxes at some point. Employers withhold payroll taxes and voluntary deductions from their employees' gross pay. Payroll checks are then issued at net pay. This is the amount of their wages less the specified withholdings. Taxes that are withheld include FICA, Medicare, federal income tax, and state and local income taxes. In addition to the employee portion of FICA, there is also a matching portion by the employers. The amounts that have been withheld from employees for payroll taxes are not funds of the employer. The employer is solely the middleman or the custodian who has a legal obligation to report and remit these amounts to the corresponding taxing jurisdictions. Employers that choose not to remit and report payroll taxes to the taxing jurisdictions find themselves in a deep hole. This is a serious offense, and there is quite a bit of penalties and fines that can be assessed up to and including jail time. Now, amongst other liabilities that might occur is liabilities for warranties. Companies often provide a warranty for the products that they sell. It's appropriate to recognize the estimated warranty expense in the same period as the sale that is recorded. So during 2016, Matrix Incorporated sells 1,000 DVD recorders for $500 each. Each DVD has a 2-year warranty. Matrix estimates that warranty costs will be $30 per recorder. The journal entry to record its sales will include a debit to cash and a credit to the sales revenue for $500,000. That's the 1,000 times 500. Both your assets and your revenues increase by $500,000 on the horizontal model. However, that's not the last thing you have to do in regards to this revenue. We have to pair that warranty expense with the revenue that was generated. The adjusting entry to recognize this warranty expense at the end of the accounting period includes a $30,000 debit. That is $30 times 1,000 units to the warranty expense, and then we would credit $30,000 to the estimated warranty liability. Liabilities and expenses increase by $30,000 on the horizontal model. Now, during that warranty period, what's going to happen is that as an organization, Matrix is going to have some actual costs. They're going to have players come back for a repair. They're going to have to replace a player. And how they handle that as they pay out for maybe those repairs to those players, is completed in this manner. When they pay warranty costs, they reduce their estimated warranty liability account by that amount. They have fulfilled their estimated and expected obligation. And then if they're paying for it in cash, cash would reduce. Both assets and liabilities decrease on the horizontal model, keeping the accounting equation in balance. We will go ahead and stop right here, where we'll pick up in long-term debt in the next video.